Hey everyone. Hello, Floyd.
Hey, Haley.
I'm here. It's a little tough sometimes. I have meetings that go until like 5 o'clock, but I can break out today.
Nice. I was because it's 4 p.m. right now for you.
Yes,
Beautiful. How's trading been for you? Are you still doing zero DT?
I I got out of the leveraged ETFs a couple of weeks ago. I'm waiting for a signal to get back in. My main trading right now is I'm doing very short term, low risk options on SanDisk, and it's working out. It's working out better than I had hoped. Actually, for some reason, you can go with very low delta options on SanDisk, and they're paying 3 or 4 times as much premium as you can get on the SPX.
Really?
I don't know if that's going to last very much longer, but I've been jumping all over it. I probably have traded 200 different option contracts on SanDisk since the beginning of the year.
Because I just looked at the price action on SanDisk and it's not been hasn't been doing very well. But for zero DT, sounds like still doing pretty darn well. Because I was looking at this volatility the past 2 weeks.
Yeah, but if you go with a delta of about 0.15 to 0.2
Mhm.
put side and on the call side, your spread is more than $1,000 between your short puts.
Oh,
And so you have a very, very high probability that they're going to expire worthless.
that's a very nice cushion.
And I don't know why SanDisk is a standout. I've looked at 30 different companies, and SanDisk has the highest premiums.
Do you just manually just go through a list to just find out which one has the highest delta, the lowest delta?
Yeah, a couple of months ago, I picked like 10 of the high flying stocks and looked at if I did a delta of 1 or 2 or 1.5 to 3 on the put and call side, how much premium could I get? That the one that was closest was Broadcom, AVGO, but Broadcom, even though it does a pretty good premium, it's only about half as much as SanDisk pays.
Oh, wow.
So anyway,
That
that's
is
that, that,
probably
that
because SanDisk is $1,800 stock and AVGO is $400.
yeah. You would still think though if you had a delta of like 0.15, which means you have a very high probability of success, that you wouldn't earn hardly any premium at all. But SanDisk pays out very nicely. Anyway, that's neither here nor there. I'm out of the leverage ETFs right now. I did very, very well on SOXL. I did okay on TQQQ, and I'm in cash right now.
It's a difficult environment to be in leverage ETFs right now. I was looking at Soxel and there's 20% days, both on the upside and the downside.
Yeah.
It's absolutely hard to hold anything. Okay, let's start this meeting. So, disclaimer. This presentation is provided solely for educational and informational purposes and should not be considered investment advice, endorsement, or recommendation to buy, sell, or hold any security. I am participating as a volunteer and am not receiving any compensation for this presentation. All investing involves risks, including the potential for significant financial loss. Viewers are encouraged to perform their own due diligence, evaluate their personal financial circumstances, and consult with a qualified professional before making any investment decisions. Neither I nor any affiliate individuals assume responsibility or liability for actions taken based on the information presented here. As you guys know, I'm a semiconductor bull. I like NVIDIA. Been investing for 20 years. Invested in the 90s. Lost a bunch of money. Also gained a bunch of money. And I just like talking to people and bringing them together. And that's why I do this. I'm still pretty much have not been invested. This I haven't updated last month, but it's pretty much exactly the same. It's probably going to be a little bit less because it's been over a year since I invested now. So today, same topics. The the main thing that's going to change is number 7. So we're going to talk about pretty much Yogesh's topic that he's been trying to hammer into us, and I'm going to bring that hammer even more. We're going to talk about credit spreads and unemployment rates and how those two tie together, and how that can be used as a way to how hard you should press the gas in your car. And the next meeting would be August 13th. So general market, I updated this about this morning. So I didn't update it according to today's data. Today was a good day. I don't expect anything to change. MMTS might go green, should be 60 to 80% invested. Or if you're in leverage ETFs, following leverage edge strategy, you might be 0% invested because we look at pretty much all the triple leverage ETFs for such wide volatile swings right now. So just be highly careful if you're still invested. Like Soxol went from, I think Soxol is what, 100 something right now. Maybe 200, maybe broke it today because it was an update. And what I mean by this is that there is a tightening of a band. So you could say it's wedging just a slight bit. So you look at Nasdaq right over here, the highs are getting lower, but the lows are a little bit tighter too. You look at the S&P 500, same thing's happening. It's wedging up a little bit. We don't know if it's going to go up to the upside or it's going to go down to the downside. Look at the Russell. The Russell is actually quite performing well. It has been on laggard for a while. So maybe this is like the regression to the mean theory where since Russell has been underperforming, finally some money's going into it. Does it mean that more money is going into small caps and the market's getting more aggressive? I don't think so at this moment. I still think it's a very volatile environment. And based on my trading history, I'm still scared. And also personal life challenges that's going on these days. Well, I shouldn't say challenges. Personal life experiences are highly, highly fun, like changing what's called a blowout at like 4 a.m. in the morning. So here's some of the stocks I've been watching. So I've been being a lot more diligent with my watch list. I've been finally getting into my routine again. And I've been finally getting into all the softwares being put together. So it's finally easier for me to understand. So what I've been watching for. So I still like stocks that are 100% gainers, both on sales, both on earnings. I still want to put out stocks for you guys to watch that either it just broke out or is starting to break out. It might be on a flat base, might be on a cup base. So we want to see what's kind of going on. So let's take a look at Zeta, our powered marketing cloud platform, right? If I take a look at the weekly chart, it looks like you could say this is very an art form. You could say it's a cup with a high handle right now, and it's kind of trending upwards a little bit. The biggest problem right here is the earnings. It's still in negative earnings once in a while. You see the March, you see the September. So you still have to be a little careful. And there's also biomedical companies. For some reason, that turned up a lot of my screens because if you look into XLH, into the healthcare sector, what may be going on is it's finally starting to break out again. It's starting right there near a new high on XLH. So the next one is Definium Therapeutics. Hopefully that's pronounced right. Why I like this one's because this price action is kind of ridiculous. Yes, there's no sales. Yes, there's no earnings. But I was one in my back of the mind, I just want to watch to see, is this going to the high tight flag territory where it's just kind of breaking out and just going? Broke out into a cup of handle base, and now it's breaking out into high tight flag. Could it be a third base potentially? Maybe. But something to watch, something that's interesting to me. Bridge Biopharma. This just happened today. The blue dot happened. It was a large volume breakout. I'm not sure exactly what happened at the end of the day, but I have to check after this meeting. Cogent Cogent so cellular immunotherapies for cancer. It's going to a flat base right now, and it's finally starting to make. It might finally start making sales in the future. Seems like there's some kind of therapy because I did see that the estimated sales is finally coming up. And as Bill O'Neill always says, it's you want to see a product out and earnings starts coming out. But these price actions keeps me interested in these stocks. Eco, finally we're out of the healthcare area. So Eco was one interesting. Metal tankers for the marine industry. It's kind of like what's happening in the Strait of Hormuz, where things are getting rough once again. And now mortgage rates are climbing up again. Who would have thought? Or everyone thought. The reason why this is interesting is because sales and earnings is in triple digits, both of them. So I'm like, this is interesting. EPS line is turning up. RS line might turn up, might not, but we'll watch it right at this pivot point, right around $59. And of course, I always like to talk about IPO. I probably should put it on a daily chart, but this gets the point across. It did, if I remember from memory, on the daily chart, it went down initially on the first day. It didn't go straight. Actually, you know what we can do? We can actually just look at the chart because why not? So Quantinium. So in the first, double check my screen. Beautiful. So in the first few days, it kind of went down, but now it's kind of slowly going upwards. So maybe there's will be a little bit of a consolidation. And it's one of the topics I like. It's AI. It's not AI. It's quantum computing, quantum computer hardware. And that might be the next step. Because as we know, we're kind of hitting a physical limit with speeds. So now we're getting more cores. But how do we get faster? The next step, theoretically, it could be quantum computing. So that might be the next big thing. Because as I go through my stock list, I always ask, is there something, the big end factor? Is there something new going on in this company, in this market that will make this stock fly off the shelves? Is it something that someone will tweet about? Is it someone will say by the slip of the tongue? Or someone somewhere in a powerful position will make a lot of money from it? It's like, what is the end factor that will help propel the stock? So that's why quantum computer hardware is one of the things I'm looking for. Robotics, quantum computing are some of the big end factors I like looking at. Anyone have any questions, comments about quantum computing? Any other stocks you want to watch? Thank you, Alex, for some more stocks to look at. Let's do it. So Alex have a few stocks in mind and keep them coming. So let's look at Ionic. I'm not sure that's how to pronounce it, but they also do quantum computers. So let's take a look at the technical action here. I'm gonna zoom in just a tad bit. I put on standard so it's a little bit easier on my eyes. So what can we say about this? I can say, man, this is messy. Not Argentina messy, but this is sorry, too much soccer. But not Argentina messy. It's like, where do you find the base? So the only way I see is if you see technically this is the uptrend right over here, then you're starting to consolidate over here. And it starts to look like maybe I'm seeing too many triangles. Maybe it starts wedging a little bit. So there might be maybe there's a buy point over here if you're extremely bullish on this, but it's not something that's super clear. How's the sales? Annual sales has been increasing. Annual earnings are still bleeding money because I assume there hasn't been. Does anyone know who's buying quantum computers right now?
I don't know that buying is the right term right now. It's more like still research.
Because like, how does Ionic actually make sales? Is my question, and they're making almost triple digit. So I'm like, they're gonna be selling something to some kind of consumer. And Alex says mostly governments buying it. Governments cutting.
Government's definitely been into it. IONQ.
So these are definitely some of the things to watch for. Thank you, Alex. So next one, I don't know this stock. I assume that just is a typo. Forte Biosciences. Ooh, let's look a little deeper into this technical bar. But actually, I want to look into the monthly chart. It feels like it could have been higher before. So it was higher before, and it's kind of near a rough quote unquote bottom. They've been bleeding money. They've been making no sales. That's the most exciting. There's probably a news announcement that just happened today. Let's see. Nope, this is old. Alex, do you know what happened with Forte Bioscience today? Nothing in the news tab for market surge, but definitely something happened when volume has jumped up over 1,000%. Yep. So skin drug data was good. Okay. So just like I said, I do like biosciences. I just want to see them earn some more money because who knows what might happen in another testing round, because I don't want 5-10% of my portfolio in one stock and then it gets hit 20-30%, which damages my portfolio about 1 to 2%. It just hurts. Any other stocks we want to look at, or we can look at some of the past stocks we can look, since I kept most of them. We can always look at all our semiconductors. Actually, you know what'll be fun? We can take a look at the triple leverage stocks. So we took a look at quantum computing, and we just did some on the spot stock analysis. Thank you, Charlie. So Forte Biosciences released phase 1, early stage, phase 1B data showing statistically significant FVASI benefit over placebo and favorable safety in vitiligo patients. That was 99% sure I pronounced that one wrong. So what's been going on? So I took this off the leverage, Edge website. So they pretty much exited to cash on 06/26. So pretty much about a week or two after the meeting, there was another buy round, and then it was another exit. So pretty much right after the meeting, it says, "Hey, go to cash." Then it's like, "Hey, this could be a good opportunity." And this is not a holy grail, right? This says most of the time, as you make your trades, you're most likely gonna hit the bull run. You're not gonna hit it every time, just like what happened on 06/22. You bought it, and 06/26 and you sold it. You bought it at what, 84, and you sold it at 72. It happens.
Not most of the time. If you entered the wrong time and if it continues for 3-4 times, it just takes out your morale really badly.
One more time, Yogesh?
You see the bottom right there on your screen?
Yes.
Yeah. If you entered there, then you have a solid gain.
Yes.
But prior to that, how many times you entered and lost?
Let's see. So there's 5 edge trades that he did. So the buy and hold profit loss is 37. And we can probably manually count it. So that's a gain. That's a gain. That is a loss. And that is a loss.
Right. So you have 2 gains and 2 losses, but the magnitude of the 2 gains is significantly higher than the drop of the 2 loss, right?
Yes.
So far, so good. What happens when you get the 3rd loss, the 4th loss, and the 5th loss?
Then you start getting a 20% batting ratio.
It's not about the batting ratio. It's more about your, like, it's not just the money part of it. Once you start getting into 3, 4, 5 strikes, it takes out your morale really badly. It just beats you really badly. And usually that can happen 6, 7 times during a bear market. But the system really works because of the bias towards the bull side, because market has bullish bias always.
I was like, that's a good topic. How do you keep
You will only know this. You will only know this if you do this as I showed you, right? I'm still working on my system. It's significantly better now. But once you start looking at different time frames and what happened during bear market and how many losses and what happened during bull market and how did it fare, when you go through those cycles, then you understand the real mechanics of this. So the system works really well on QQQ, as in TQQQ or SPXL or those market ETFs. For semiconductors, it worked well because that sector was in a super bullish mode after 2015. But if you do it before 2015, it will not work.
That is true. Because only recently it's like, hey, you invested in April this year, you invested in April last year, you've done fantastic.
Right.
But if you held, like, let's say you bought in, oh, I just heard about this new, let's just go with my friend. My friend, she bought Soxel at 280 because her husband bought Soxel at like 150, and she was like, man, I'll just buy it after like a month later. And I haven't asked her, I haven't followed up. She's like, oh, what are you guys gonna do? Oh, we're just gonna buy and hold. And I've been telling them, you cannot buy and hold leverage ETFs. Like, I don't know where all my tech friends are getting their advice from, but they're starting to buy a lot more leverage ETFs. Even back in 2021, they started buying leverage ETFs. I just don't comprehend why they buy and hold it, because it's not a buy and hold strategy. So just be careful. That's just something that's been bugging me for a while, that I'm like, guys, can you please stop buying and holding leverage ETFs? So how's it doing? So the drawdown does hurt at 35%. It does profit at 39%. So dang, that actually really hurts on your psychology, depending on when this happens. So you can go up 39%, and then your drawdown could be 35%. So you could see your account going up to, like, very, very well on a TQQQ, but then you also might go down 35, which means it breaks even if a math like that happens. So how's it doing overall? What has it been doing in the past year? Fast Nail has been doing so well. As we all know, Soxel in the past year, 800%. Sorry, 640%. That's a 4x. Keep forgetting that Gary Taylor does a 4x Soxel, and that's 800%. A 3x Soxel is 640%.
Well, what is 4x Soxel?
There's another ETF that does 4x semiconductors. Yes.
What's the ticker?
It is SOX. I don't think it says it's SOXL. Let's just look really quick. because I know I saw it one time. I was like, and I was like, there's no way I'm doing Forex. Let's go, trading view. Let's go. Well, that loads. Then the next one is going to be, so the next one for the year is just going to be bulls and fangs. Wow, I'm surprised. It's the bulls in past year. But we do, let's say performance year to date. It's still stock sold. Then it goes into the fangs hasn't done too well, about 2%. And then technology bull run has done 60. Good for technology. And the past month, you've just been slapped in the face quite a bit. You've just been negative in almost everything except for financial bull markets and the home builders and supplies. Over the last week, pretty much OXL is about negative. I am trying to open. There's my layouts. Yep. It is SOXL. It is on, it's on the Euronet Paris. So it is also SOXL. That's absolutely insane. Instead of the regular SOXL, which is 3x, it's on the NYSE.
So this one is not on US market.
So just be careful when you guys buy SOXL. It could be a 3x or 4x. It could make you smile a lot, it could make you smile a little bit less. But in this case, in the last week, the 4x has done negative 23 and the 3x has done negative 32, which is interesting. A little counterintuitive. And I know this is a little bit, thank you, James. So Forex is on the London Stock Exchange. I don't really follow international markets as well. So what's going on with all 8 that I follow, from TQQ, SOXL, BLZ, and NAIL? Pretty much it's sell, 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 never buy. Fang Yu had a buy. NAIL is still sold. And financial bulls are also sold. So pretty much if you're following leverage ETFs, just like Floyd, is you're most likely out of the market until you get your next signal. I think I finally got my rhythm down. I'm finally updating my equities calendar, and I'm finally really concentrating on what affects the market. So I'm really trying to, with these major events, I'm always trying to find out what is affecting the markets at least 1% or more. So consumer price index, producer price index, retail sales, imports, exports, GDP, unemployment.
What's the intent? Let's say one of these event drives the market up 1% or drives the market down by 1%. What difference does it make?
The difference for me is how much I can sleep at night. Because I don't like waking up and all of a sudden I don't like being reactive.
Right, but if you're so worried about even like 1% and anything below, let's say 3% or 5%, if you're so worried, you might as well just buy a hedge, like a perpetual hedge on your portfolio.
I definitely can. But sometimes it's really, I worry when I'm just newly into the market, since I'm terrible at buying. Let's all agree on that. I'm terrible at buying right now. I haven't bought.
Right, but even then, let's say you do your, what I'm trying to understand is like a lot of people follow these events. I have not yet realized, unless you're a day trader, then it's totally a different ballgame. But unless you're a day trader, how is this helping you to do what? What kind of trading are you going to do if the market is going to go down by 1% or going to go up by 1% based on whatever that result came out on that event?
It helps. So for me, it helps keep me calm. So if I wake up and I'm like, I expect some volatility in the market. It's not like I wake up and I look at the market and I'm like, what's
so
going on?
This is just to keep you calm, but it's not really to do any trade.
It's not really to do trades at all. I'm not gonna day trade like all of a sudden full MAC meeting is gonna come out right at 11 a.m. PM PST. Then it's like, okay, I'm gonna buy a hedge on this to make sure my portfolio is okay. My portfolio is doing fine. I'm just gonna keep it. I'm gonna watch it. Oh, look, they just released the notes. Oh, look, he's speaking. It went down. Well, as we've traded more, is just because the interest rates went up and the stock market went down, does not mean that the stock market will go down again tomorrow. Sometimes in a matter of a week, the announcement doesn't even matter. By the time Wednesday hits and Friday hits, doesn't freaking matter. But I just don't want to have I have that feeling where it's like,
so you are in that perpetual loop that when your phone is on the table and ting ting, you have to see who the heck is sending you a message. You can't let it go.
Yes, that is definitely me, where it's like, so my phone is actually on perpetually silent. Pretty much, I only get calls. No notifications on my phone, not even the stock market. My stock market checks every single day is usually on the hour and the top of the hour. And that's as much as I get to check the market, unless I have a position I'm really watching that day. Because it's like checking emails. If you're checking emails based on feeling, the anxiety goes through the roof. If I check every five, it's like when you check emails every 5 minutes at a company, you get people who will tell you, it's like, oh my gosh, you're very responsive. But the amount of anxiety and the amount of confusion that creates is totally not worth it. So I've developed like I only check emails about 2, maybe 3 times a day. And when I check for about 30 minutes. And usually if I have that time restriction, it keeps me calmer, gets me to the point, and gets me working on stuff that I really want to do instead of being a what I call office monkey, where I just respond to stuff. It's just all it's almost like my training is managing my own psychology. We know the techniques, we know the trades, and it's about portfolio management and managing to make sure I follow my own rules. Oh, I forgot to include the slide, but any questions on anything here? Any more stocks you guys want to look at before we go into our educational topic that's inspired by Yogesh? This one's fine. So we know technical. So this one's about credit spread and unemployment. We really want to combine economic data to really know when we should go aggressive, when we should rein it back. There's life situations that happen that we should rein it back. There's things that, let's say, in my life, a newborn baby. That's when I will really rein it back because my sleep is inconsistent. It's not as long, it's not as deep, it's not as whatever as I would like. And I have to have a new sense of rest. And once I get that, I really have to concentrate I have to really have like a separate personality that tells me is like of a constant monitoring of my own health to make sure that I'm doing mentally and physically okay. And also eat a lot better. Less junk food because I don't get as much sleep. So that's what we have to do for the economy. We have to say what is going on in the economy. You have to say what's going on in the big picture, medium picture, and small picture. Right? Small picture is me. Medium picture is how you're doing on your portfolio. And the big picture is how's the whole economy doing? Because your portfolio is considered one of the leaders because you do watch the market, you do pay attention to what's going on, and you're trying to make the best decision based on the limited information that you do have. So let's get started. We said the disclaimer, please don't sue. So macro context matters. How much do you want to press on that gas pedal? We look at price charts, we look at earnings reports, we look at news headlines. We might be Stanley Druckenmiller that look at news headlines. So we all know about the FOMC meetings where interest rates go up, interest rates go down. It affects for me in real estate and stock market. It affects interest rates. It affects borrowing costs for businesses. It affects every single person in America. That's why everyone pays attention, and that's why it's always the big thing. But is it the big thing? Is it the one and only we should look at? But there are two indicators: the unemployment and the credit spread that Yogesh has said. It's the widening, the tightening, and maybe the stability of it. And that's what we combine those two criteria. It's designed to tell us how aggressively we should buy and also when to buy. Maybe not what to buy, but when to buy. So why does it matter for us? If we're doing leverage ETFs, we're doing 2x, 3x, maybe even 4x, as we talked about for SOXL, the London exchange, it hurts. A 50% drop on a 2x it's nearly 100%. Not 100% because of how the contracts work on ETFs, but what if it's a 4x leverage? If it's a 25% drop, that absolutely hurts. And if you look into leverage, and if you look into the ETFs of 3x and 4x, and you do see the 30-40% drops, you get to see that the magnification is not exactly 3 times or 4 times because of how the contracts are structured. It's a little bit less or a little bit more depending on the ticker. So that's why we really have to pay attention to both the unemployment rate and also the credit spreads. So I've talked about narrowing, I talked about widening. So what is going on? We like stuff predictable, we like stuff safe. When things are safe, people are more aggressive. When it's like, hey, government's giving you money, you'll have more than enough money in your bank account to put food on the table, more than enough money to pay all your rent and pay your mortgage to live in your house. People say, hey, I can spend money. What happens when credit gets a little tight? When borrowing costs rise, when companies are not spending as much money on advertising, on giving freebies to customers. That's when things are getting a little bit more. That's when you should be on the, let's say, not the red alert yet, but yellow, if not red alert, of like what's going on in the economy. Are people, is the American consumer still really the consumer that you can never underestimate? Are they still going to spend that money? That's why in the past I've talked about things, how much money is in money market accounts, how many people, how much money is in the personal savings. And these are all things that we can check from the Fed database from the Federal Reserve. So if it narrows stables, great. Let's just spend a bunch. Let the consumers, let the AI companies, let Google, Tesla, Meta spend all their money on AI chips to buy from NVIDIA. And NVIDIA in turn makes so many that more data centers come to fruition. And from more data centers, buys more fiber. From more fiber, it creates more material. And so on and so on. But then what happens when combined with unemployment? So employment is great. Where it's like, hey, back in, what was unemployment great? It was only a few years ago, 2021. What happened with unemployment? Tech has now said that unemployment has really, in 2021, unemployment is like, we need more people. We don't need more project managers. We need more engineers. We're going to hire anything with two legs. Here's an example from groups of people I know. So this guy was a project manager. He was at one of the big fangs, and he was a contractor. They needed more hands on deck. Fast forward, he was a contractor for about a year. He hit his contractual limit, and what ended up happening is, fast forward a few years, he's now a car salesman. And I'm like, wait, you worked in the Bay Area as project manager in one of the FANG companies. Now, fast forward to today, you're now a car salesman. What happened? Well, I applied for every job and this company really liked me. And then afterwards, I tried, the job market got tight, and now he's a car salesman and he's now trying to just make ends meet. So, how do you go from a contractor project manager at some of the big top tech firms to a car salesman? That's when you know it's like, hey, this unemployment rate really does matter because jobs aren't plentiful anymore in 2021, 2022. Now, jobs in 2026, they're a lot harder to come by. So people are a lot more careful. Meta is laying off employees. You hear a lot of people just getting laid off. Hey, I'm now a new college grad. I did computer science. I did this for 4 years in 2022 when the job market was great. And now I'm out in 2026. What can I do? You don't get a job because there's middle level engineers that are taking entry level salaries now because they're trying to cut costs because they're using AI. But now the new headline is AI costs too much and now we need to hire more people. So it's like, it's a very interesting market that we're in right now where are we hitting that AI productivity and at what cost? Physical, at cost as in what cost to the company? Is it actually cheaper to hire engineers? Who knows? So that's what unemployment matters, because if you're confident about your job, you're confident about your savings, you're confident about your spending, guess what? Here's $200 for Cloud AI Max. Why not? And just use as many tokens as possible. And they won't even bat an eye because it makes them more money than an engineer. And hey, where can you even get any employees for $200 a month? If you can get an AI agent for $200, why not? So combining credit spreads and kind of combining unemployment, I try to make things simple. So I was thinking, what's easy? What do we do? What do I do every day that people can relate to? It's a traffic light system. In most of the developed world, there's a traffic light system that most people follow. I drove in Vietnam. In some parts of Vietnam, traffic lights are not followed. Green means go, yellow means go, red means go. And you just weave between traffic. Quite fun. But in the United States, green, yellow, red. Green means go, yellow means caution, red means stop. What it means is that green means like, go ahead, go on margin. Red means like, hey, If you really like the stock, go ahead and buy it. But just be cognizant of the overall market. Credit spreads are widening, unemployment is increasing. Unless the stock is a superpower, it might go up in a bear market. Most stocks don't. But if it does go up in a bear market, it might rocket up when it's a bull market. So when credit spreads are. So what constitutes a green light? A green light says that credit spreads are stable, they're narrowing, meaning it's getting cheaper to borrow money, and they're also going more narrow. They're not going from 1%, 2%. They're going from 2% to 1% or 1% to 1.25. It's very, very narrow. And it's just kind of fluctuating around that. It's like the new Fed chair. What is he going to do? Is he going to increase? Is he going to decrease? Is the president gonna? How much president influence does he have on the Fed? He's not supposed to have a lot, but he does have. It seems like he does have a lot of push and pull these days because he can't even affect the FIFA World Cup, where he can't say, "Hey, this player was banned for 1 game suspension," but he somehow came back in. So it seems like things are a little bit uncertain right now. And of course, green light for unemployment, it's low or is improving, meaning it's like 4% to 3%, or even like, who knows, 2%. And of course, remember, unemployment is that there's people who take themselves out of the job market who are no longer looking for a job. And all of these data is done kind of all these data points are currently being updated. So it's they use a little bit more technology to get all these unemployment data. So what's yellow light? Credit's like, hey, it's now 1.5%, 2%. All of a sudden, oh, we haven't went to 3% in like 5 years, and all of a sudden it's going to 3%. That's getting a little more expensive. Then maybe it goes to 5%. Then almost every single quarter goes up a little bit more, just like what happened a few years ago. Unemployment can still remain stable, but the cost of borrowing is getting harder and harder. The cost of borrowing is getting more and more. So what is red light? Things are just freaking expensive, right? And people are just like, hey, I'm going to work even more. I'm in SF, right? People are going to work even more for the same amount of pay for the same amount of hours. And so the productivity goes up, but the pay doesn't go up. So the dollar per hour is actually getting less and less because people are like, I really want to keep my job. I really have to outperform. I really have to join this team at Waymo because Waymo is becoming the leading robotaxi. I'm not going to join Lucid because Lucid is still trying to catch up and they're just partnering up with Uber. Any questions? Any comments? So, knowing the stop line system, knowing when to really push on the gas pedal, when to really press on the brakes, you have to trade with the environment. All of these tell me how aggressive should you trade? What are the current conditions? How does the current affect your strategy? Should you go on 2x margin? Should you go on 3x margin? Or should I even go on 5x margin? It depends on the situation. And you just don't know which, and you have to pick the situation where it does go into the right sector. Like we were discussing, we buy in April for SOXL, both in 2025 and 2026. Dang, quite good. Especially if you bought it in your retirement account. That's probably some of the best we've seen in the past decade, if not more. So it's deteriorating, lighten up. It's improving, sure. Kind of hit the gas pedal a little more. Play with your gains, but also know that your gains is part of your wins because at any given second, when the market is open, you could always sell for profit. So depending on how you trade, depending on how you handle money, that's when you have to consider both your credit spreads, your unemployment to see how much you should press on that gas pedal. Everything's good, everything's great. See if there's any macroeconomic conditions, just like Yogesh was asking me. Why do you even use these? Why do you even care about these equity events that affect you? Because it keeps me calm and collected. Because once my emotions get kind of crazy, my trading gets like a little insane. Some people have asked me, is like, how did you know to sell here? Well, I didn't. I kind of look at my diary and it says, why did I sell? I made enough money. And I've done that a few times now. It's like, if you made enough money, it's like, why don't you just make more? Because I know the amount of money I want to make. And if I make more than that, it gets donated to charity. So you don't need any more money than that. And sometimes it's a good year. I have some spending money, I have some play money. I get to go to New Zealand, have some fun, go travel for a month. Then it's all good. More than enough for the year. I come back next year, I'll come back in a month and can trade again. So my final thought on this: 3 different lights, 3 different lenses, and there's one decision. Do I stay or do I go? Do I stay in my current course or do I keep on going a little harder? And I always use technical analysis for when should we trade, fundamentals for what should we trade, like those triple sales growth, those triple earnings. How good are those? Then we go into the macro indicators, which is that credit spread and the unemployment, and that tells me the aggressiveness of the trade. So hopefully that sheds some light on the credit spread, on unemployment. But there is one person I would like to hear is like, Yogesh, what do you think? What do you want to add on to this presentation?
I mean, it's all good, but unless you show the real chart, like unemployment rate and the credit spread, like just by talking, like I know we have shared those charts earlier, so most people here might know them, but without seeing it, you will not realize what you're talking about. Also, it would be nice if you can connect the dots, like, why that really happens when unemployment rate goes up or credit spread goes up. Why do we get a recession? And what happens when one goes up and the other doesn't?
Oh, you're right about what happens when one goes up and the other doesn't. I haven't really considered that possibility because unemployment currently is going down and credit spread is going up. So we're kind of, well, I guess I
Is credit spread going up?
thought it was.
So see, that's what I said, right? Unless you see the actual charts, I mean, theory is all good. I like practicals. Theory works in the books. It doesn't work in real life. Practicals work in real life. So
Practicals work in real life. Correct.
so there you go. So if you look at this, the credit spreads are also low,
Credit spreads are also low.
which is why market is at all-time high.
So credit spreads are going down. Unemployment is going down. Well, 4%.
Right. So a little uptick or downtick doesn't change much. Again, these charts are updated on a monthly basis. So on a weekly basis or on a daily basis, there's no relevance for this. The key thing here is to understand what exactly is happening. Why are we looking at these two charts? So first thing is, let's take an example of bear market 2022. So what was happening around that time frame? Why did we get a bear market in the first place? So if you look at the unemployment chart, there was not much unemployment, right? I mean, it was kind of flat, little bit uptick here and there, but nothing much was happening. But what was happening with credit spreads?
Not to go to communities, corporate bond yields.
You might want to go to Trading View. They may have it. I don't know why this site keeps changing all those things. There you go. Right there, fourth line.
This is it. I'm going to do monthly chart.
Now this is fine. You can see here, right? In 2022, what was happening? Credit spreads was going up, right? You see that line? So what does that really mean? What do you mean by credit spreads was going up? That means if I'm a business, I'm driving a business or I'm leading a business, to borrow money, it's very expensive for me. So I'm not going to expand. That is what it means by credit spreads are going up. So what happens during that time? You won't get money. Nobody is willing to provide you capital. So kind of economic goes little dampening. It's not a full-blown recession, but we get a bear market. So I'm not laying off my people. I simply cannot grow my business anymore because it is too expensive to get money. Nobody's willing to lend it. So that's why I get a recession. So that's how you link these two. So when credit spreads rise and when unemployment is flat, you typically end up getting a bear market, not a full-blown recession. Or you can also get a correction, if you want to call it that. Now, go ahead.
And if we look at the market, I was just going to go link it back to the market. So it's just going back to January of 2022 where the credit spread started going up. So as the credit spread started going up, if we look at the Nasdaq, it was at 16-ish thousand. From there, the bottom hit in November 2022, and it finally hit about 10,000. So if we take a look at the credit spread, you can see that the credit spread in October of 2022 hit a high, and then it finally started tapering down all the way until now. So just like what Yogesh was saying, it's literally as credit spread's going up, borrowing cost is getting more expensive, and the stock market did hit a recession or correction.
Correct. So now we just saw a scenario where one is going up, the other is not. What happens when unemployment goes up and credit spread do not go up? Will that scenario ever happen? That's the first question. No, likelihood of that scenario happening is almost zero. Why? Because if you have a very high unemployment, what is it that telling you? Economy is not doing good. Nobody is willing to hire because nobody is expanding the business. Why anybody is going to give you money to expand anyways? No one. So that scenario will never happen. Or at least I haven't seen it happening. Plus logic tells me it will never happen. So that's why you will never see a scenario where credit spreads go down and unemployment rate goes up. It may happen in some scenario. I don't know which one it is, but at least from the analysis that I've done, I don't think it's even plausible that the scenario may happen.
I wonder if we can do a division of credit spreads, the inverse credit spreads divided by unemployment. Will that tell us when there's a divergence?
It might. I mean, there will be divergence here and there, but we are not looking for small divergences, right? We are looking for a trend.
Yes.
That's what makes the difference. So the third scenario is when both are going up. Now, that's when you usually get a recession. Why? Because if economy is not doing well, in my business, earlier example was that nobody's willing to give me money, but I'm still doing okay. I have enough customers. I can still keep my own people. I'm great. So no worries, just a dip in the market, not recession, but just a bear market or just a correction of 20% or 30%, whatever that is, right? So that's perfectly fine. But when the economy breaks, when now my demand has gone down significantly, I am really difficult to pay my workers, I'm going to lay off my workers. I'm certainly not going to expand the business. The economy is really bad, so nobody wants to lend the money. So naturally, credit is very tight. So credit spread starts moving higher. Unemployment rate also starts moving higher because people are getting laid off.
Can you overlap them on TradingView? I think you can, right?
Yeah,
If I
you can.
That'd be interesting.
I need to change these. Give me a sec. Unemployment. There we go. Two blue lines at the same time makes it very, very hard. There we go.
You can see in 2022, unemployment remained flat. So we got a correction. But what happened in 2020? You can see spike in both, which is why market just tanked, or we had something called flash crash. Now that doesn't happen every 2 years, but we got to experience it. But if you go back enough, you can see.
Please don't break the chart.
So you can see it clearly. The credit spread, the high of credit spread and the bottom in the market was very close.
High credit spreads right over here in March of 2020. And the Nasdaq low is pretty much in March of 2020 because we're looking at monthly charts, and it pretty much did coincide.
So that's the story behind why this recession, why do we get a recession when they both are rising? If you think about it, it makes perfect sense, right? If the economy is not doing well, people are getting laid off, it's very high, tight credit, nobody's willing to lend the money, economy is contracting, perfect scenario. Why would market go up? No, investors don't want to put money in the market. So market will collapse, which is what happens in recession. It goes down significantly. So can you scroll back? And you
let me like this.
Yeah. So back in 2008, you can see the same scenario playing out again. What is the blue line?
Blue
That's the
line
credit spread, right?
Correct.
Yeah. So you can see during financial crisis, credit spread went through the roof. What happened to the market? It dropped significantly. What happened to the unemployment? It also went through the roof. So there's a reason why they are connected.
So just to verbalize the chart, so on November 08, credit spread literally went through the roof, highest ever. And then unemployment was pretty much at its peak from November 09. Was at November 09 and started climbing like crazy ever since January 08. And we look at unemployment. That's unemployment. If we look at Nasdaq, the Nasdaq low was in February 09. So as unemployment was climbing unemployment was going up, credit spreads was as all-time peaks. Let's take a look at 2000 since we're all going here. It's actually, and Yogesh, you are 100% right. I should have brought up charts. All great, saying a bunch of words, but when you look at a chart, it's a lot easier to visualize. So thank you, Yogesh, for the advice.
Yeah, I mean, we cannot make the story here. It's right there in front of you, right?
It's literally right in front of us. If we look at the unemployment rate, look at, let's say, 2000. It was, so NASDAQ reached the low in 2002. Unemployment rate was at its high in 2003. But that is, the trend is kind of, I would say that's a little sideways. And the NASDAQ peak was February 2000. So NASDAQ went
Right. So
short
look
terms.
at it, put things in the context here, right? So now we are thinking, oh, wait a minute. Why is unemployment not rising from 2000? Look what's happening to the credit spread, the blue line. That is going crazy.
Absolutely
Right.
insane since 1997.
Correct.
And from 1997 to 2002, that's when it just kept on. It is oscillating up and down, but generally it's just going straight up.
Right. So market went parabolic during 99. You can see that the green line.
Right here.
Right.
Yep.
That just went crazy. So at some point, market realized this is absurd. Like companies are borrowing ton of money, but I don't see the return. And then I'm sure some companies started collapsing around that same time, which is why market start dropping. And you can see the first dip in the credit spread, but then it could not hold it. It still went up and made all-time high by 2003. And that is where the unemployment rate started rising as well. So we are pretty much in that same cycle today, where AI companies are borrowing like crazy, telling you that, oh, you know what? This is going to solve everybody's problem. Sure. Yes, in theory, everything works. But in practical, it doesn't. So at some point, we don't know when, but whenever that point comes in next 2 years, could be next 3 months, 6 months, 1 year, who knows? Whenever that point comes, when companies starts realizing that, wait a minute, I put $1 billion into this, where is my return? I cannot provide return. There is no return. What do? Cut my cost. What is my biggest cost? Employees.
Yep.
Then I start doing mass layoffs, which you are already seeing, like Meta, Microsoft, all these companies are laying off chunks like 5,000 here, 2,000 there, 8,000 here. So it's like in small chunks. They're not doing like 30,000, 50,000. They're doing small chunks so it doesn't get into the top headlines of all the news channels and everything.
Yep.
It doesn't scare everyone.
Can we go back to 2026 just so you're talking?
Right. So right now, the story is all great because you know what? Credit spreads are low. Unemployment rate is not really rising much. So markets are at all-time high. At some point, that's going to change. The first thing, if I'm reading this right, the first thing we'll see is credit spread will start tightening. How will that happen? So if I'm reading the macroeconomic correctly, we have already seen inflation going up. The Fed chairman has already said that, yeah, you know what, I would like to reduce rates, but not going to happen. Most likely they will increase rates. What happens when Fed increases rate? Credit tightening happens. Now, to borrow the same amount of money, investors are going to ask more interest. I cannot afford it. So I cannot expand my business. That's where the cycle starts.
I guess that's assuming the AI companies can't self-finance, right?
Correct.
Yep.
Which they have been doing a lot of.
Yep. So as we have seen, it's like a circular motion going on that NVIDIA by taking a stake in AMD or some other company, and they are buying NVIDIA chips. So, like I pat your back, you pat my back. That's what is going on.
It is.
So at some point, and also to add to all this stuff, like companies in US are spending $1 billion. The model that runs the cloud or chat GPT to solve the same problem, they charge like $2, between $2 and $3. That's how much cost it is. The same problem to solve with a Chinese model is 30 cents. And it's comparable to cloud and chat GPT. Now that's a problem for American companies. Because if somebody else can deliver the same solution for 30 cents, why would anybody pay $2? Which is also the reason ChatGPT or OpenAI pushed their IPO to 2027 because they cannot get $1 trillion valuation. Slowly people are realizing this. Companies are realizing this. Wait a minute, I am spending $1 billion, and I'm talking about these huge companies. Okay, I'm not talking about small firms. I'm talking about big companies. They are realizing that, hey, wait a minute, I bought into this AI hype. I have the cloud model, the best Opus model, or whichever it is, and I'm paying that company $300 million a year. Where is my return? And if you cannot justify that, at some point, your board of directors are going to say, oh, wait a minute. You spent $300 billion and you cannot show the return. What the hell?
That is slightly happening right now. Some companies I know of are actually reining in all their AI stuff. Instead of saying, everyone start using AI, they're actually saying, hey, you're using too much AI. What the heck is all this AI money going to?
Yep, exactly.
Well,
So
maybe that's why OpenAI is taking a chunk from the government.
Yep.
To support it.
True.
Where else would it come? I mean, it's kind of like being stuck between a rock and a hard place. If you're trying to compete with China or stay on top,
correct.
You got to keep
And the
moving
bigger
forward.
issue with AI is like, so we need to understand what's the difference between AI and back then, like a software company, right? Like Microsoft software, Microsoft Office. Let's say my cost of building the software was $100, Microsoft Office suite. Okay, that was $100. So I get one customer, he's willing to pay $10. My cost is still $100. I get two customers, my cost is still $100, but now I'm getting $20. So my margin increases as I get new customer, my cost remains the same. That's not the case with AI. With every new customer, my cost also goes up. It doesn't go down. So initially it costed me $100. I get a new customer, great. You're willing to pay me $10, but my first cost is $100. The second customer is willing to pay me $10, but my cost is not 100 anymore. It's 110 or 105. So the AI
Well, that's
cost,
because they're continuing the build out. Is that why you're saying that?
because you have to compute cost, right? The AI models have to use your compute power.
Yeah.
So
You're just talking about raw power. You're not talking about build outs of new facilities.
correct. Right. And the other problem is like Microsoft Office gets upgrades maybe once a year, maybe two times a year. A major upgrade maybe once in 5 years. AI models are updated every freaking week. You get a new AI model. And you have to do it because you have to compete with the world. So the cost of doing that also goes up significantly. So it's like a perpetual cycle. You have to be the top of the game, like Chat GPT or cloud. You have to be the best AI model. Your cost is exponentially high. The problem with that approach is at some point, investors are going to say, well, wait a minute. I'm not just going to put money all the time. I need to get my money back. When will that be? Nobody has the answer because nobody knows how. I mean, everybody has the model, but they don't have a plan to sell it in a way where they can recoup the cost, which is why SpaceX did the best thing. They just did their IPO right at the peak.
Oh, Elon is a very smart guy.
Now it will be a very big challenge for ChatGPT and OpenAI and cloud to get that kind of valuation because slowly people are realizing, companies are realizing that, I cannot spend this kind of money every year. And plus, I don't get any productivity out of it. So at some point, they're going to stop putting more money into it. On the other side, economy is not doing great because the inflation will be rising. The war is going on side by side. Oil prices are rising. So the credit spread will start rising. The companies will start laying off because they cannot sustain all of this. So it will be like a perfect storm, building slowly. All of these things are monthly charts. So they take time to build. But once they start in a trend, then they just go fast. So it might take another 6 months just to build the trend. And we might be choppy over here. Maybe we get 10% correction. Again, we go all-time high, something like that, and kind of chop around. And then once the trend starts on these two, unemployment and credit spread, that's when the market will collapse because there's no money left.
So what evidence is it that the earnings are not rising, though? Are they not?
That depends because depending on what accounting methods you're following and what accounting frauds you are willing to do, you can change all of those numbers, right?
That is true.
So you might even still have great earnings. I mean, look at the earnings for SanDisk. They are awesome, but still the stock did have some correction, right? Same goes for Micron. So if the earnings and sales are great, why isn't the stock going up?
Well, most of their earnings has to do with supply and demand, isn't it?
Yep,
It has nothing to do with production.
correct. So yeah, a company can sign an MOU with Micron saying, yeah, we are going to buy 5 billion worth of storage or memory, but that's just an MOU. I can cancel it. But when Micron is
beginning.
going to show it in their earnings, they're going to say, oh, we got a $5 billion contract. It all
Yeah, but they
depends how the company is showing. So that's why, I mean, we don't have to go through all the different charts. All we have
Yeah.
to care about is these two lines. As long as they're not trending higher up, we are good. If the moment you see they're going up together, well, then protect your portfolio, do a long-term hedge, whatever you need to do. Because most likely market will experience. Now, how big the drop will be, nobody can say that. But usually in a recession, market tends to drop anywhere between 30 to 80%. So take your pick.
30 to 80% just hurts.
I'll say.
It's another one of the 08 or 2002 or 2000. Thank you, Yogesh. That was probably better than my presentation, not gonna lie. Because you get to see actual charts and see actual credit spreads and also the interest rates going. So that was possibly good. That is actually it for me talking about credit spreads and unemployment. I don't have any more charts. I don't have any more slides. If you guys want, we can talk about more AI. We still have 45 minutes. We can look at more stocks. What would you guys like to do? We can talk about portfolio allocation. I'm still 0% invested. I can take a poll of how everyone's invested if anyone's interested in that. What do you guys think?
Well, I thought that was quite interesting, that presentation.
Thank you. I think definitely Yogesh has definitely contributed a lot. So I'm always super thankful for every single time he shows up. He contributes, shows up, and just being himself. So Yogesh, any way we can help you out, you're definitely a wealth of knowledge. So I'm sure this goes for everyone here. We're happy to help you out when you need the help. So slides recording, they're over here. If I don't ask, Yogesh is the canary. You go, James. He's gonna be screaming at the top of the bill. He's gonna be screaming in front of the room saying, "It's like, look at the credit spreads. You see credit spreads and unemployment, they're both going up." So slides recordings, just guys pass me an email. I'm finally catching up with all my backlog over the past few months. So I'm getting more responsive these days. I'm able to just respond in general. I'm able to just get my life together again. So next month in August, there's gonna be another meeting, second Thursday a month. My apologies again. I sent the reminder last minute. I'm trying to send it out on Monday, if not the week before. So I'm gonna try to get that out. I'm trying to be better. So I appreciate your patience. I appreciate your knowledge. So I'm gonna end today's meeting a little bit earlier this time. So thank you everyone for. Does anyone have any updates on their trading styles? Anyone wants to talk about anything? I'll still be here. But thank you for showing up today. Thank you for your knowledge and thank you for listening.
Thank you, Haley.
You're welcome. Oh, so James, Yogesh did do his TQQ strategy. So it seems like Yogesh has. How is your TQQ strategy, Yogesh?
It's whatever I showed last time, I've improved a lot. So I'm trying to build something where, like I showed last time, right? You see the real power of the strategy when you actually show year by year performance, and also like, what percentage of gains are coming. 0 to 5%, how many trades did 0 to 5%, 0 to 15, or 15, 5 to 15%, 15 to 20%, stuff like that. So that's when you see the real power of the XXX ETF strategy. Because so I'm still like, there are a few things that I still need to fix in it or add in it, I would say. But essentially, that's what I'm doing. Once I'm done, then I can showcase it. But essentially, the goal is, and not just to show how it is doing, but also test it. So like with parameters, you can change your parameters and it will tell you out of say 10-year range, how did it do for first 6 years? and then using the same parameters, how it did. So kind of a test, sample and test kind of thing. So it does that as well. And all of this is built in TradingView. So
does it do it on a per ETF, or does it do it on a
you can put whatever
ETF?
ETF you want. You can use a stock, you can use an ETF. So whatever ETF you select on the chart, that is what it will do. It will show all these details based on that. It is not going to show you a basket of things. It will not run on 10 different ETFs and show you the results. It's per ETF.
It won't rank ETFs either.
Right. So it's not a ranking system. And I thought about doing that earlier, but the problem with that is it requires a lot of coding, and more importantly, it requires a lot of compute, because then it has to iteratively go through each of the tickers. And TradingView is not built that way. So there are maximum number of tokens that you can use in TradingView, and I kind of have hit the limit. So I'm trying to. So there are different ways to save on those tokens. I've coded certain things to save on the tokens to get what I want, because my key thing was that's whenever I provide some parameters. So for example, in this case, you can apply an RSI strategy on TQQ and see the performance. You can apply stochastics, you can apply MACD. So there are a couple of 4, 5, or 6 indicators that you can use one at a time, which one you want. Select different parameters, and it will run the whole back test and show the performance. But my goal was to also show how many trades. So let's say over a period of 10 years, it did say 60 trades. Then each trade, I want to know how many trades were in different buckets. So which one made 100%, which one made 200%, which one made, what was the bucket which got the maximum number of trades? And can I do anything about it? So the strategy will tell you that, hey, you're leaving a lot of money on the table. You should go and tweak your trailing stop. Now there is an actionable item for me that I can do. So I will change it right in that strategy, and it will immediately tell me how it performed. Then another thing was, it will tell me that, hey, by the way, you should also check your ATR stop, because right now your ATR stop is killing some of the trades. Great. So then I can go and all of these things happen right there. So the whole back test runs within seconds. So you get the output right there. It tells you how it is performing. It tells you where you can tweak stuff. It gives you drawdowns, everything on the same chart. Everything is right there. So
I'm guessing it works on stocks too then.
Yeah. It works on anything. It's up to you what you want to run it on. I was designing it for TQQQ specifically because that was my goal. But essentially, you can run on anything, and you can tweak the parameters for all these indicators and everything. So pretty much open.
Is this something you're going to provide on subscription or something?
That's my plan at some point. If it gets to a point where it's really usable, I know it's usable for sure, but I'm still not there. I'm still trying to fix few things because there are some nuances that are happening. I tried to. The reason when Heli was showing that we get out here, in the recent ones, the last 2 trades were a loss. So I was looking at an area where in bear market, when you're applying this strategy, there are 6 trades that go in a loss. So if you're deploying $10,000, by the end of that 6th trade, you would have lost almost 50%. That's a big loss.
That's huge.
So even if you reduce your stop limit and get it down to say 20%, even then losing 6 trades, that's a big one. It just hits you really badly that every freaking trade you're losing. So then the question comes okay, so I actually implemented after 2 trades, if 2 trades are wrong, then I won't take the 3rd trade. Well, the 3rd trade that worked the best, I missed it.
So are you deciding these thresholds with heuristics, or do you have some training?
So those thresholds, basically, as I said, right? So when you're doing this on a longer period, right? 5-year, 10-year, and you can select the dates, it kind of tells you, your stop loss, and you can see it on the chart whether it was the right call. And if you think, I should give it a little bit more weight to run through it. So then you can change the stop loss and it will show you the numbers right away. So that's the beauty of it. The back test is really easy to do. You don't need to really code anything. It is already there. Everything is all there. You just change the numbers and it will show you the outcome right there. And in some instances, it actually tells you what you should do. That's the part that I like the most, because most of these back tests don't tell you what to do. It just shows the numbers. In this case, it will tell you that, hey, you're leaving some money on the table. Maybe you need to tweak your trailing stop. If you had total 20 trades, it will tell you how many of them were exited because of the trailing stop and how many of them were exited because of the stop loss, or how many of them were exited because of the ATR stop. Then you can kind of hone in and say, okay, my ATR is killing most of my trades. What the heck is going on? Maybe I need to change those parameters. And is it really helping you? Because when you do all this, so one of the things I realized is when I was doing this whole thing, not every trade should have the same trailing stop. What does that mean? For example, if I have a trade that has done 100%, then I can have a more cushion for a trailing stop. I don't need to put it right at 5% or something like that. When you do that, it significantly changes the math. It significantly changes the outcome. So for the scenario that I was running, it went from 500K to 900K just by changing that. So what I did was, if my trade is 0 to 10%, my trailing stop is 5%. If my gain is from say 10 to 20%, my trailing stop is say 8%. If it goes from, so like that, when it goes beyond 100, my trailing stop is at 20%. That changes a lot of things. So that kind of gives you an idea, which I didn't even think about when I was starting it. But when I could see the numbers, then you kind of see this different dimensions that you can apply to it.
I'm wondering if velocity would have any significance in this. I guess you're doing day to day, right? You're not intraday.
Yeah, so it's daily, not intraday. Correct.
How much time have you put into this, Yogesh?
I don't know, a lot of time. Didn't calculate that, but probably a couple of months, I would say.
This reminds me, it's like you're making a strategy for our own custom strategy per individual, which is absolutely interesting.
But the way I say is, it's more like a backtesting engine. You can say most people feel that, okay, RSI I will use when it crosses from 30, I'll buy. When it drops from 80, I will sell. Yes, that is a very bookish strategy. It works really good when somebody's showing you very specific charts, and when you read it in the book, perfect. Does it really work in real world? Apply it and see it, and you will only know it when you actually see it over a longer period of time. So that's why I said it's a backtesting engine where you can use it for any strategy, any ticker you want, and then put any numbers, parameters that you want to, maybe RSI 14, maybe RSI 5, maybe MACD, maybe stochastics, maybe CCI or other indicators. But that kind of tells you whether it's really working or it's not. It's just working in some sections, but rest of the time it just doesn't work. So that was my intent to build it in the first place. And then, of course, when I saw Floyd doing it manually on the Excel, I'm like, okay, that's not going to happen with me, not doing it manually. So, but luckily, TradingView has the capability to do this kind of stuff. Even the Thinkorswim has it, but it has its own limitations as well. So initially I built it in Thinkorswim, but then there are certain things that you just simply cannot do in Thinkorswim. And TradingView has those inbuilt tables and stuff like that, so it's much easier. So, but yeah, so I have it. I'll showcase it.
I think in fact, let us know anytime.
So how do you define if it has alpha decision making?
What do you mean?
Where are you going to automate this?
It is automated. So when you say decision making, what exactly are you saying?
Well, I guess when I say alpha, I say, so I'm doing something similar, Yogesh, but I'm doing it all in Python. I'm not using any services except for pulling data.
Okay.
But I guess alpha over a scanner and looking at charts. I don't know how you would measure it, but smarter than you. Let's put it that way.
Right, but smarter to do what?
Trade and make money.
Oh, okay. So you mean to say, like, once it fires a buy signal, can it automatically trade on your behalf? That's what you're asking, right? Automated trading, is that what you're saying?
I guess you're doing this totally on technical, so there's no fundamental behind this, right?
Correct.
So, like Market Surge has similar things as far as charting coming
Right.
up with.
So charting, so there is a big difference, right? A lot of the platforms have a scanner. TradingView also has a scanner. MarketView, Market Surge has a scanner. FinViz has a scanner. So
Yeah.
that's fine. So, but none of the tools will tell you how will this strategy perform, right? So, as an example, as I said,
You're
RSI
really
14.
focusing on the trading strategy, pretty much. It's the trading aspect of the stock, looking at technicals.
Correct. Right. So this is more like a back testing. So if I use these particular parameters with this particular indicator, in this case, it could be MACD, stochastic, RSI, whichever you want, perpetually, and I want to see for, say, last 10 years, how did it perform on QQQQ or SPY or TQQQ? And would it really work? And it will tell you whether in the end, was your PNL positive or was it negative, or it was just really bad.
So if you compared it to, I guess you did have a chart where you're comparing it to holding for the same period, right?
Right. So the strategy also gives you buy and hold. If you just buy and hold from the beginning of the date that you provided and the end date that you provided, if you just hold it, what will be the outcome? What will be the drawdown?
And what typically, I guess you found in that one instance was 2% better than the SPY or something.
So it depends, right? So buy and hold, as I said, right? It depends for what time period you're applying this strategy, right? So buy and hold, if you apply this strategy right from the beginning when TQQ came out and you do buy and hold till now, then buy and hold probably does much better. But the drawdowns are also humongous.
I guess so. So maybe that might be the alpha I'm thinking about, is whether or not your strategy would actually outperform on the average a buy and hold strategy. I think historically that the answer has been no, right? On most of these. Is that true?
Again, I mean, I don't want to say yes or no because it completely depends on when are you really buying. That's where it matters. Because if you ended up buying at the top of the market and then TQQ went down drastically and then you're holding it, then that's where the strategy plays a big role because you have a stop limit in the strategy. So you are not going to hold it to the bottom. You are getting out with a 5% loss. And then you will enter back when it is right down there. That's when your strategy does much better versus buy and hold, because buy and hold, it has to come all the way up where you bought it first. And then from there, it takes off. But that's why you get to see all of that in the back testing, because that's the only way to see it or know it, basically.
Well, I'm interested in trying it out when you get to it.
Yep, I'll share it once I'm there.
I have the other side of it. I've been using a machine learning algorithm to rank stocks. So I'm ranking stocks, 0 to 100, and I can pick whatever. Right now, I have about 3,000 stocks in the database. I can do 3,000, or I can sort them by market size or something, and then it goes. The output of that ranking goes into a scanner, and the scanner picks out things that I know I want to see in a stock, like I want to find the tail of the rising edge. And so the scanner pulls out others, and so I have a technical rank and I have a fundamentals rank, and I put them all together, and it pops up maybe 3 stocks, 4 stocks.
Okay.
I don't know how good it is, because I haven't gotten to the trading aspect of it.
No, so if you pick the stock, let's say 3 stocks shows up today, you just note them down. You buy first thing in the morning, or not real buy, but paper buy. You just buy first thing in the morning in an Excel. You just put them, and then how do they perform for next 1 week, next 1 month, next 3 months, next 6 months.
Right.
And that will
That's
tell
what
you whether your picks are right picks. And my gut feel is, if your core of your strategy, like the alpha, as you said, or the scanning parameters that you use, the first week and the first month will be good. Once it gets near, that's when it will have an issue. So
I
but
think
then
I'm
again,
like, it took you 3 months to do what you're doing, so I guess I'm going to give my 3 months to finish that part of it up.
I would highly encourage, use Cloud, use
Oh, I am using Claude.
ChatGPT.
I got 1,000 lines of Python already.
Oh, cool. But I don't know how you do it. My way of doing it is a little different. I don't have any paid subscriptions to any of these AI models. I use all free. But the way I do it is a little different. So I would first put my idea, whatever I'm working on, in Gemini,
Yeah.
and I'll tell Gemini, let's make a plan. What is the feasible plan to make this happen? And then Gemini comes up with a plan. I take the plan, I put it in the cloud and say, hey, Cloud, Gemini told me this. What do you think? And Cloud gives me his answer. I take Cloud, put it in Gemini, and tell Gemini, the Cloud told me this. What is your answer? So I go back and forth between the two. And of course, I'm reading the whole thing. It's not like I'm just copy pasting stuff. So I'm making sure I understand what is going on in the first place. And I sometimes I will question it. And then once I have come to a point where it's a good enough plan that can provide what I'm looking for, then I would actually start coding. Until that point, it's just back and forth.
Well, I use Claude Code. I have the subscription. I use it, the Windows version of it, where it looks at my drive and just takes off.
Okay.
I mean, it's like I'm running. It's just
So
running
just
all the time.
since you have it installed on your computer, make sure you don't keep any personal stuff on that computer, because if you recently read an article, I was reading an article on Cloud. They have barred Chinese customers.
Yeah.
But how did they know they were Chinese? Because they were able to, behind the back, go into the computer and understand few things without notifying the customer. So some of the programmers found it out, and now Alibaba has banned Cloud from their company altogether. So just something should be aware of.
I don't have any Schwab or trading account keys on it. So, but yeah, that is a concern. Do all this work and then find someone else take my money away.
Yep. But good. It'll pay off big time. I'm sure all other people are hating us because they probably are not understanding, or we are boring them.
One or the other. I don't know how many are still online here. Still
There's
got
about
19.
19.
Yeah, once I
Pretty
have it,
good.
I will share it. I'll show it. I'm working on two other things as well. One is specifically for options. So for example, if I'm watching SanDisk, then what option should I play? Is this the right time to do a back ratio spread, or is this the right time to do a vertical spread, or is this the right time to do a zebra? Those kind of things.
SanDisk is a pretty good place to be doing options.
Yeah, I mean, you can do it on any stock. You just have to bring the ticker and it will tell you.
I think the fees are higher on San.
It depends on the volatility percentile, IV percentile, implied volatility percentile. But yeah, I mean, so my intent is basically I do options. So I wanted to have something that can easily tell me, without doing the math, that, hey, is this the right candidate right now to do a vertical or a spread or a calendar spread or diagonal or just long call or those kind of things.
I'm not an options guy. Not yet.
And to support to that, now I'm building another indicator that will tell me the directional bias based on a couple of different things. So is this the right time? Is it a full blown on bullish bias? Because if that is the case, I can do a zebra play on that, or I can do a long call. So kind of combine two different indicators and it kind of gives you best of both worlds.
How long have you been trading, Yogesh?
Many years. My first trade was back in 99. Of course, I lost, but.
I've only been doing it for 3 years, so.
Cool.
I'm still green under the collar.
I mean, the good part is right now, a lot of things are available on internet. You need to know right stuff, but the good thing is if you are willing to learn, sky is the limit. There's a lot of stuff out there for free. You can go read it, do a lot of different things. So that's the good thing. A bad thing is, of course, as you said, there's a lot of waste out there as well. So you really need to figure out which one is the right thing to do. But yeah, I mean, at least in last 10, 15 years or after 2010, 2015 onwards, a lot of good stuff has come out. So sky is the limit if you really want to learn stuff. I would highly encourage. If you're not familiar with options, do get familiar because it really gives you an edge, especially when you have some big positions in a particular stock. Like Heli doesn't want to sell his NVDA, he wants to hold it, give it to his kids. So, if you know options, then you don't have to cash out. You can actually hedge the position and keep it perpetually if you want. So there are ways to do it.
Yep, I can take a loan on it and to spend the money without actually selling my stock and stuff like that.
Yep.
Yeah,
So-
we're happy. I'm happy to be an alpha tester for you to help break the system. So
Sure.
do subscriptions, there'll be less people break in. I'm very happy to break systems.
No, I mean, I'll of course open it up for trial runs, and once I have it at that point when I'm confident that it'll run very well. So I'll let you
Are
guys
you
know.
going to use any market regime type stuff like the VIX or the unemployment or the credit spread or any of that to tell you to not get in?
No, because this is purely on technical. The backtesting engine is purely on technical. So adding those, I mean, I can add, but that will not help the system per se. So that's why I'm not really going to do that. I actually tried a bunch of things, as I said, during the bear market in 2022. There were like 6 losing trades. So I was trying to figure out a way to minimize that. I tried a couple of things, but it doesn't really work because, as I said, what ends up happening is you miss that one trade that does the best. And by doing that, if you lose the best trade, what's the point, right? So it really doesn't help. So the only way that I know to minimize that is position sizing. So if you are having losing trades 2 in a row or 3 in a row, then just reduce your position size. But then the problem with that approach is if you get in the right trade, your position size is not normal, and now you have to chase it. So it's like there is no best of both worlds. You either have to miss it, or you just have to lose some of the capital. But that's why I didn't say this is a more like like XXX strategy. This is more a backtesting engine. You decide what you want to do.
So you do this full time now, Yogesh, or not?
No. I full time. Who knows? Someday. But
Fun.
yes, learn the hard way. That's for true. Cool.
I got to learn how to get out more than I need to learn how to get in.
As I said, just follow some system. That's a lot easier. Like a stop loss. Hey, if I have a not stop loss, I mean trailing stop, 10% or ATR stop, or like if it drops below 21 EMA or 50 EMA, any system, whatever works for you, right? Pick your system and don't try to copy somebody else's system. But whatever works for you, just follow that and stick to it. And yes, there will be times when the stock dips intraday right below your level and you get stopped out. And the next thing happens, it goes right up $5. That will happen. But that's, I call that cost of doing business. So. But
that's the fun about the stock market. We get to learn every single day. And sometimes it's noisy that we thought we learned something, but honestly, it would be better out of our brain.
Yes.
That's the fun.
Cool.
That was a good discussion. Thank you, Richard. Thank you, Yogesh. So this is the second goodbye now. so Yogesh, I'm sure I'm speaking from by the way, multiple people have messaged me as like, hey, can Yogesh present again? Can we get his slides? Can we get all his things? I was like, yeah, but Yogesh is not, I know you're not ready yet and you're getting closer by the day. So we are very excited for whatever you put out and we're happy to help test it and promote you.
Yep. Thank you guys. Really appreciate it. I'll let you guys know. My goal was to finish it by July. I'm close to it. It's not done yet. So I don't know whether I can make it, but I'll try my best. Thank you.
Awesome. We're excited for it. I'm sure I'm speaking for everyone in that regards. So thank you for attending. Thank you for showing up. Thank you for having the discussions. This wouldn't have been the same meetup without all these discussions. Catch everyone later.
Thank you guys. Have a good day.
Night.
Thanks.